Hi, I'm Danny Ecker. Here's your Chicago Business Today midday report. Groupon shares debuted on the Nasdaq this morning with a boost right from the opening bell. The stock opened up nearly 50% higher than its IPO price of $20 per share. The IPO raised $700 million for the Chicago-based daily deal company, up from the $540 million initially planned. That's good for a $12.7 billion valuation, making Groupon the 8th largest company in Chicago by market capitalization. Now this 3-year-old fast-growing startup has to begin its life as a publicly traded company. Lisa Leiter talked with Crain senior reporter John Pletz about what's next for Groupon.
So John, let's start off with what Groupon intends to do with all this money it's raising. What is the company's plan?
Well, they didn't say specifically how they're going to use it, but certainly acquisitions are a possibility. It's a company that's done more than a dozen so far in just 3 years. And you're already starting to see a shakeout in the space. Buy With Me was acquired by Gilt Group, so I wouldn't be surprised to see an acquisition or two in their future.
Okay, now that they're a public company, they're going to have to start playing the earnings game, answering to Wall Street and to shareholders. You and I went and spoke with Rick Sommer, an analyst at Morningstar last week, and let's hear what he had to say about that.
What would happen for them is if they keep driving that profitability, we're going to see massive declines in growth. Consider the mature markets like Chicago, like Boston. Those are starting to decline in terms of number of transactions, much smaller upticks in terms of revenues that they're being able to generate. Look at the entire company base. We've already had significant declines on a quarter-to-quarter basis. Growth has been cut in half each quarter for the last couple of quarters. This sequential growth declines should be very strong indicators for how quickly even annual growth can tail off.
John, the numbers really tell the story here. As Groupon has decreased its marketing spending, its growth has tanked along with it. Do they have to choose going forward between profitability and growth?
Well, it's a tricky dance for Groupon for sure. The land grab phase is probably over. Clearly, Wall Street wants to see profits. They've really cut back on their marketing spending. And what they told investors during this roadshow over the last 2 weeks is that they're going to dial that back, and they're looking to show profits.
Groupon is selling less than 5% of the company in this IPO. It's the smallest float of any internet company over the past decade. That's going to be a little bit difficult for some big institutional investors to get into this stock, right? So what are we likely to see? Are we looking at a secondary offering here?
Well, certainly the big investors expect that's going to come in short order, and that's not an uncommon thing. Groupon is selling a very, very small part, and really the big institutional investors who were in on the roadshow for the last couple of weeks are going to spend the next 6 months looking at the company, figuring out their business model, deciding whether they like it, and that's probably when you'll start seeing them buy in.
Rick Sommer of Morningstar told us that he thinks the stock is going to trade down. It's only a question of when, not if. But other IPOs in the tech sector that have come to market in the last few months have done pretty well. LinkedIn is still trading double its IPO price. Zillow is about 50% above its IPO price. Pandora is really the only one that hasn't done very much. What are your sources telling you is the outlook for the stock from here?
Well, a lot of the investors think that Groupon will see some good activity, a good pop. The limited float will keep demand up, and you'll probably see a good bump. The real question is how long it takes for what Rick talked about, which is inevitably young companies, particularly tech companies, usually have a moment where they stumble, they miss a target or two, the stock the stock falls, and then the question is whether it'll pick itself back up. So I think that's really one of the things that investors will be watching for.
There's been a lot of debate as to whether Groupon is a technology company. What do you think is the most critical thing that Groupon needs to prove to its investors going forward?
Well, what the investors want to see out of that technology is what Groupon was promising on that roadshow, is that they've been spending money on technology that will make them able to offer far better deals, much more targeted than they have before, and much more targeted than their competitors. And ultimately, at the end of the day, it's the technology and the customer list that wins. It allows them to get better merchants. It allows you to get better deals, and that's what's going to keep you coming back. And so those are the things that investors are going to watch for the next 6, 12, 18 months, is they're going to want to see, what's the repeat business.
And that brings me to my last question, which is when you're talking about technology, that sort of brings up the talk about comparisons between Groupon and Amazon. You've been covering the technology space for a long time. What do you make of those comparisons, and what are people telling you? Are they valid or not?
Well, there's certainly the opportunity there for Groupon to sell a lot more things, and they've shown that. They're selling travel deals, they're selling products. The analogy to Amazon is a bit of a stretch for some folks because Amazon at its heart was a technology company. And they have just amazing technology that continues. And Groupon's not anywhere near that yet.
All right, John. Well, we'll be watching this for sure. Thanks so much.
Thanks.
And that's this edition of Chicago Business Today. Stick with chicagobusiness.com for more Groupon news. Thanks for watching. Have a great weekend. We'll see you back here on Monday.